Let's take a look at the current state of the US labor market. Over the past few months, recent data has suggested that things may be slowing down slightly. How worried should we really be about this trend? In reality, the cooling didn't just start a few months ago, it has been developing for about a year. If you compare the average number of jobs added recently to the previous few years, you'll notice that job growth has already declined quite a bit. So yes, there is some reason for concern. Rising unemployment and a reduction in job creation are not positive signals. However, one encouraging factor is that economic output has remained fairly strong. GDP growth has continued at a solid pace, which in some ways is an even more important indicator of economic health. When GDP is expanding at around 2.5 to 3%, but job creation is slowing, it raises an interesting question. Does the economy now require fewer workers to produce the same level of output? From a purely mathematical perspective, when production grows but employment rises more slowly, it means productivity is improving. Higher productivity is generally beneficial because it is one of the main drivers of long-term economic prosperity. In fact, increases in real wages and living standards depend heavily on productivity gains. There are several possible explanations for why this gap between growth and hiring is appearing now. Artificial intelligence is one theory that people often mention, but another important factor is that many companies are becoming more cautious. Businesses are uneasy about tariffs and broader economic uncertainty. After the pandemic, firms hired aggressively because it was extremely difficult to find workers. Many companies brought in anyone they could to keep operations running. Now they are trying to adjust their workforce and return to more sustainable staffing levels. Employers are not only concerned about tariffs, they're also dealing with the direct financial impact of them. Passing those added costs on to customers has proven challenging. Because of that, businesses may look for other ways to reduce expenses. Sometimes that means cutting labor costs, which can lead to fewer jobs. Ironically, tariffs might increase productivity by forcing companies to streamline operations, but at the same time, they could reduce employment. Another interesting development in the labor market is where new jobs are appearing. Recently, a large share of employment growth has come from the healthcare sector. In some months, healthcare accounted for nearly all job gains. That tells us something about the direction of the economy. Healthcare positions are obviously important and valuable. Society needs doctors, nurses, and other professionals to support an aging population. However, some economists argue that these jobs do not directly produce goods in the same way industries like manufacturing do. Ideally, job growth would be more balanced across multiple sectors, including manufacturing, services, and other productive industries. Manufacturing employment has actually been declining. In the most recent data, factory jobs dropped again, and this has been a pattern over the past year. Many policymakers worry about this trend because manufacturing has traditionally been viewed as a backbone of economic stability. Another topic frequently discussed in relation to the labor market is immigration. Recently, immigration flows have slowed compared with previous years, and some reports even suggest that certain workers are leaving the country. The question is whether that is influencing employment trends. Some analysts argue that reduced immigration is creating labor shortages. However, the broader data doesn't strongly support that explanation right now. Labor force participation is declining, job openings are decreasing, and the unemployment rate has been edging upward. These indicators suggest the labor market may simply be loosening overall rather than suffering from a shortage of workers. Corporate leaders are also less concerned about finding employees. During earnings calls, many CEOs are talking more about layoffs than about hiring challenges. Artificial intelligence is another factor often discussed when analyzing employment trends. While AI probably isn't the main reason for declines in sectors like manufacturing, it may be influencing corporate planning. Companies may be holding back on hiring because they believe AI systems will soon handle certain tasks. In that sense, the technology may already be affecting hiring decisions, even if it hasn't dramatically reduced employment yet. For investors, the labor market is only one piece of the puzzle. What tends to matter more is the overall economic environment. One scenario that investors fear is stagflation, a situation where inflation remains high while economic growth slows and unemployment rises. That combination can be particularly difficult for financial markets. If both inflation and unemployment increase at the same time, it puts central banks in a difficult position. Policies that help reduce inflation might hurt employment, while policies designed to boost jobs could worsen inflation. One way policymakers could reduce inflationary pressure would be to remove tariffs that raise costs for businesses. Lower input costs might reduce the need for companies to raise prices. Beyond that, there may be limited short-term solutions. Over the longer term, improving economic flexibility through deregulation and increased competition could strengthen growth and resilience. The U.S. Federal Reserve also faces a complicated challenge in this environment. Its mandate requires it to focus on both stable prices and maximum employment. Balancing those two goals can become very difficult when inflation and unemployment move in the wrong direction at the same time. Markets had previously expected the Fed to cut interest rates twice this year. However, those expectations have begun to change due to factors such as geopolitical tensions and rising oil prices, which can push inflation higher. It now seems unlikely that rates will increase, but the number of potential rate cuts may be smaller than previously anticipated. Another area investors are watching closely is private credit. In recent years, many loans were issued to technology companies, particularly software firms, based on projected revenue rather than actual profitability. These are sometimes referred to as ARR loans, meaning they rely on annual recurring revenue. The challenge with that approach is that strong revenue doesn't always guarantee financial stability. During economic slowdowns, some of these companies may struggle to repay their loans. As a result, there could be some losses in the private credit market. However, many analysts believe the financial system today is still far more stable than it was before the 2008 financial crisis. When investing in private markets, valuations aren't updated daily like publicly traded assets. Investors must rely on quarterly reports and financial statements to estimate the value of those holdings. While that means information may not always be perfectly current, careful analysis of company performance can still provide useful insight. Finally, global geopolitical tensions also play a role in financial markets. Conflicts can affect everything from oil prices to investor behavior. Traditionally, assets such as the US dollar, government bonds, and gold have been considered safe havens during uncertain times. Recently, the dollar has strengthened during periods of tension, reinforcing its reputation as a safe asset. However, government bonds have behaved somewhat differently. Because war can push inflation higher, bonds may lose value, which explains why they sometimes sell off even during crises. Gold and silver, meanwhile, have been performing strongly, which often signals that investors are feeling uneasy about the global environment. Yet at the same time, stock markets have remained relatively stable. This unusual combination, strong demand for traditional safe assets alongside continued investment in equities, has left many analysts trying to interpret what it means for the future of the global economy. Don't forget to like and subscribe.